Okay, this is theme 2 of July 2nd's podcast. We're going to talk about economics here a little bit. That's the backdrop to everything. Rates drive everything, and I think that if you recognize that we have a Fed that has raised rates to 5.5%, yes, they've raised rates 11 times from zero, fastest hiking period ever. Anybody that owns a risk asset thinks that's reckless. It's not. The fact is that, we're coming from zero. That was the aberration. 5.5%, it's pretty normal, and frankly, 5.5% is below the 30 or 40 or 50-year average of interest rates. We were about 6.5%. So I am of the belief that policy is not restrictive. Some would argue against that. I would have them look at the Chicago Fed, which clearly Mr. Powell has not done. The Chicago Fed has a liquidity index, and it's running at the most supportive liquidity, the most liquid position in 20 years, since the last financial crisis, or since the last dot-com boom and stock market bubble. So I think that to argue that the rates are restrictive and they have to come down, I think is ingenuous. The government loves inflation. Corporate America loves inflation. They can pass on price increases to their customers. So the majority of investment advisors listen to the economists at their firm, and those guys are told, our job here is to get money into our funds, so let's tell everybody it's going up. And that's what they do. Which is why I love being an independent strategist, because you can be independent and you can be objective and you can shed your biases and look at the truths and get your emotions out of the way and recognize that the U.S. economy's got a ton of liquidity. The government spent $11 trillion through COVID and none of it's come back out. So most of that money's in the financial system, and a lot of it's in corporate America. The balance sheets of corporate America are as strong as they've been. Even household balance sheets are very strong. So economically, I think the economy is doing okay financially. I think the problem is that it's changing, and the fact is that 2/3 of the economy is services, and services are going up in price still, mainly because wages are going up in price. You see these stories about restaurant chains closing and retail chains closing. That's inflation, and that is crime, and a little bit of a change in the legal system that doesn't prosecute criminality, which I think will probably change too, because it's the blowback from retailers, small businesses, households, neighborhoods, cities is getting so bad that the voting bloc in America is probably going to take a pretty hard look at some of these sort of social trends we've seen over the last 3 years and probably push back on that a little bit. So economically, I think that the Fed has a responsibility in its balanced mandate, its dual mandate between full employment and stable prices, is to get prices back down to a level which is not so harmful to small businesses and middle class. That's 2%. We're running CPI is 3.3, and that means that consumer price inflation is 3.3% higher than it was last year. And a year ago, it was 4.5% higher than it was the year before that. And the year before that, it was 6% higher than it was the year before that. So just because the rate of change is a little bit slower doesn't mean prices are down. Economists like to think that way, but the people that have to pay for things look in the aggregate. And the fact is that most prices for most consumers, for most items, are up between 20 and 40% since the pandemic. And that's why the polls are tight for the presidency. People don't hear the story in Washington like the Washington storytellers would like you to believe. Investors don't believe the economists at their asset management company saying that they're thrilled that inflation is now going down. It's not going down, it's going up. And people feel that. So I think a little critical thinking, a little bit of a sort of a non-biased look at the narrative is probably in order for a lot of people, and I think elections do that. So I would expect more criticism of the policy that's been in place for 3 years, and that's being polite. More criticism of a policy. And in fact, it's not just this country. If you look at what's going on in Europe, big second round of elections in France, big one coming up in the UK. We've had elections in Italy, Sweden, the Netherlands, Hungary, Poland, all over. And the trend is that small businesses and households look to be blowing back against the thematic trend over the last 30 years in Europe and here of bigger government. Bigger government is non-productive and they spend a lot of money, and that money's got to come from somewhere, and it's coming from taxpayers. And taxpayers have had it. They are up to their ears in costs, and their quality of life is going down. And it's because companies can't make a profit, and households don't have any disposable income. And there's nobody to blame but the policies or the politicians that have put these policies in place. So it's not just the U.S., it's all over. We see it in Brazil, we see it in India. So we see it in Japan. So I think that small businesses and households are making their voices heard across the world, and that is that big government and the inflation that they have created over the last 3 to 4 years is the trend that they just can't handle for the next 3 or 4 years. So you're going to see some change in government leadership in many countries, and that's the reason for it. It's got nothing to do with personalities, okay?